Hey everyone, welcome back to Corporate Decoder, the place where we decode the financial jargon so you don't have to a smirky joke about the upcoming report details. Today, we're unboxing a new financial move from Sonim Technologies Incorporated, and let me tell you, it's a big one. Think about a company saying, hey, we might need a lot of cash and here is how we're planning to get it. We will break down what it means for their future and whether it's a smart play. As always, if you find this kind of no-nonsense financial breakdown helpful, make sure you hit that subscribe button and join our growing community. We also have a Discord channel linked in the description below where we discuss these filings in real time. So Sonim Technologies Incorporated, otherwise known as SOM on the stock exchange, just dropped a significant announcement. It's all about a new way for them to raise capital through something called a chef purchase agreement and a registration rights agreement. This essentially gives them the option to sell up to a whopping $500 million worth of their common stock to Chardon Capital Markets Incorporated. Now, this isn't like a typical stock offering where they sell a huge chunk all at once. It's more like a flexible vending machine for cash. The company can decide when and how much stock to sell on various days based on market conditions and their needs. They are not forced to sell anything. This is a key point. The mechanics of this share facility are pretty interesting. Once everything is set up after a certain date called commencement, the company can tell Chardon to buy shares. The price they get paid for these shares is based on the volume-weighted average price of the stock on a given day, but with a 3.5% discount. This discount covers Chardon's involvement and risk, essentially. This agreement can last for up to 3 years or until they hit that $500 million mark, or if things go really south with the company. They also have the option to end the agreement themselves with a 10-day notice. Chardon can also end it, but only under certain specific situations. Now, here is a crucial bit. They can only sell up to about 2 million shares without shareholder approval, or unless the stock price is above a certain level. This is to prevent excessive dilution, which is when your ownership stake gets smaller because so many new shares are issued. They also can't let Chardon own more than 4.99% of the company at any given time. This helps manage ownership stakes and potential control issues. So what are they going to do with this potential cash infusion? A good chunk, at least a third, will go towards paying off a $2.7 million promissory note. The rest will be used for operations, overall business strategy, working capital, and general corporate purposes. This sounds like they need cash to keep the lights on and to fund their growth plans. Looking at the bigger picture, this facility is designed to give Sonim flexible access to funding without the immediate pressure of a large underwritten offering. It's similar to an at-the-market equity facility, allowing them to tap into the market piece by piece. The idea is to raise capital on a periodic basis as needed. The registration rights agreement is tied to this. It means that the shares Chardon buys from Sonim will eventually be registered, so Chardon can sell them in the public market if they choose to. This is standard practice for these types of agreements. The company has a lot of discretion here, which is good. They can choose to sell shares when the stock price is favorable, and when they genuinely need the cash. If they sell a lot of shares when the price is low, they might end up with less cash than they hoped for. But if they sell when the price is high, they get more money. The company also retains control to exit this agreement if needed. This provides a layer of protection. They can walk away if they find better financing options, or if the market conditions make this facility unattractive. There aren't any really harsh penalties or upfront fees in this agreement outside of legal costs. It's not like they've committed to selling a certain amount of stock on a strict timeline. The main things are the purchase price mechanism, the limits on dilution, and the overall cap on the facility. Now, for my take, Sonim Technologies is clearly signaling a need for significant capital to fund its operations and strategic initiatives. This committed equity facility provides them with a flexible safety net. The good news is they have control over when and how much they sell, and there are limits to prevent excessive dilution. The risk is that they might have to sell shares at less than ideal prices if their stock performance falters. Issuing shares to raise money can be a double-edged sword. On one hand, it provides necessary funds. On the other hand, it can signal to the market that the company is struggling to generate cash internally. The use of proceeds is also noteworthy. Prepaying a significant promissory note is a responsible move. It reduces their debt burden and interest expenses. The remaining funds for operations and corporate purposes are vital for day-to-day functioning and future growth. But it also highlights that incoming cash flow from their business may not be enough to cover these at the moment. In conclusion, this move by Sonim Technologies Incorporated provides them with a substantial potential funding source. It's a strategic decision that offers flexibility, but also carries the inherent risks of equity financing. As investors well need to watch how they utilize this facility and whether their business strategy translates into profitable growth to justify the potential dilution. Alright, that's our breakdown of Sonim Technologies' incorporated latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.